Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Bridgford food stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a micro-cap company, 103 million market cap. They're trading at $11.32 a share, and they have 9 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow doesn't look so good. It's negative every year. Although the negative isn't getting worse, it's getting slightly better. It was negative 15 million in 2020, negative 13 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was positive in 2020, negative in 2021, but it jumped up to 45 million in 2022, and it's still 45 million in the trailing 12 months. Revenue is a sales for the company, and that grew a lot from 200 million to 266 million. That's a growth of 34% over 2 years. It did come down a little in the trailing 12 months to 259 million. We estimated 4 years of future free cash flows. Then we estimated a terminal value, which is all cash flows past year 4, that's 300 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $229 million. We divide that by 9 million shares. And we get a calculated stock price of $25. They're trading at $11, so they're trading at a 55% discount. It's a strong buy according to the model. I did assume their revenue would grow 5% a year for the next 3 years. And I also assumed they would have positive free cash flow by 2025. I don't think my assumptions were too aggressive, so I think there's a decent chance they could hit these numbers. There are 67 companies in the packaged foods industry. And if Bridgford has a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 56 million in capex, which is between the median and average. They don't have much debt. For every dollar of equity, they have 10 cents of debt. Their debt to equity ratio is 0.1, much better than the median average. They don't pay a dividend, of course. They're generating negative free cash flow. A really small market cap. They're ranked 40th out of the 67 companies. They have a really good price to book. It's below 1, so that means their equity is higher than their market cap. They're worth more in liquidation than as an active business. An amazing PE of 2.3. We can't look at their price to free cash flow since they have negative free cash flow. And a really good price to sales, 0.4. Since it's below 0.5, that means their revenue is more than double their market cap. And they are growing. Their 5-year annual revenue growth rate is 9%, higher than the average and median. So the reason I picked this company is because I ran a stock screener in E-Trade. I selected all the smaller microcap stocks that had positive earnings. And this file is on my Patreon channel. So if you're a Patreon member, you can get this Excel file and look through it. If any company has a PE below 10, they're in blue. Price to sales below 2, they're in blue. A price to book below 2. Market cap over cash below 10, debt over cash below 10%. Only 5 companies were blue for all 5 categories. So I'm going to try to do a video on each of these 5 companies to see if I want to invest in them. Let's look at their latest 10Q. This is for the 3 months ending 4/14/2023 compared to the same period in 2022. Sales are down. They were 60 million last year, now 55.5 million. Even though this is a small company relative to most of the companies that are publicly traded, it's still a lot of revenue. Could you imagine having a company with $55 million of sales? So even the smallest companies that are publicly traded are still much bigger than most businesses. Here's a breakdown of the 55 million. 12 million frozen foods, 44 million snack foods. Just by looking at the breakdown of revenue, now we know exactly what they sell. Or at least we have a good idea of what they sell. Here's a different breakdown of their revenue. 45 million is retail sales, 10.6 million food services. And a breakdown of the 45 million of retail sales, 29 million is direct store delivery. So they sell directly to supermarkets. 14.5 million direct customer warehouse. 12 million of their sales are to distributors, frozen food products. 1.3 million retail, 10.6 million food service. Because selling frozen items is not easy. Selling potato chips is very easy. Anybody can deliver that. But it takes a special type of vehicle to transport frozen food. especially in the summer. So that's why they go through distributors for their frozen food products and not deliver it themselves. You do give up some margin by going through distributors, but it does remove a lot of headaches, and it's also easier to scale. Now, this is a really cool chart. It shows you why their sales decreased $4.5 million from last year. They increased their prices 2.1%, so that increased sales 1.3 million. But unit sales decreased 7.7%. That accounted for 5 million. Then you have returns, 142,000, and then promotions, 690,000. That accounts for the $4.5 million decrease, which is a 7.5% decrease from 2022. Let's go back to their income statement. Below revenue is cost of revenue. These are all the expenses directly related to generating the revenue. They need to buy some of the food they sell or buy the ingredients. Then they manufacture it, and they have payroll costs, lots of expenses. That's 40 million. So their gross profit is 15.5 million. Gross profit is revenue minus cost of revenue. Their gross profit in frozen food is 2.4 million. In snack food, it's 13 million. Their margins are lower in frozen food, 20%. They convert 20% of their revenue to gross profit. Their margins in snack food are 30%. Then you have SG&A, selling, general, and administrative costs. That's payroll for support functions. That's 15 million. So they actually have a loss in frozen foods, a loss of 848,000. Its snack foods is a gain of 1.1 million. They should probably just focus on snack foods and get rid of frozen foods. But last year they had a gain of 540,000 in frozen foods. So maybe their distributors are taking a bigger cut this year than last year. Let's go back to the income statement. Their operating income this quarter is 280,000. Last year it was 1.5 million. Last year they spent 318,000 of interest on their debt. This year 100,000. Their income before taxes are 313,000. Taxes of 164,000. So net income of 149,000. Last year was 800,000. So their EPS is only 2 cents. Last year was 9 cents. And they have the same exact number of shares outstanding last year as in this year. But for the trailing 6 months, they have the same EPS, 12 cents, when you compare 2022 to 2023. Maybe we could all get together, all my subscribers, and buy up the company. Their biggest customer by far is Walmart, 30% of their sales. Dollar General is second, 16%. Walmart is 27% of their accounts receivables. Dollar General is also 27% of their receivables. Let's learn more about what they actually sell. We operate in 2 segments, the processing and distribution of frozen food products and the processing and distribution of snack food products. We manufacture and distribute an extensive line of food products, including biscuits, bread dough items, rolled dough items, dry sausage products, and beef jerky. Our frozen food segment manufactures and distributes biscuits, bread, rolls, and shelf-stable sandwiches. Our frozen food business covers the U.S. Products produced by the frozen food products segment are supplied to food service and retail distributors who take title to the product upon shipment receipt through company-leased long-haul vehicles. Our snack food products segment distributes products manufactured by us. So they don't buy someone else's product and sell it. They make it themselves. The dry sausage division includes products such as jerky, meat snacks, sausage, and pepperoni products. Our snack food product segment sells approximately 170 different items through a direct store delivery network and customer-owned distribution centers, serving approximately 19,000 supermarkets. That's a pretty good reach. Also mass merchandise and convenience retail stores located in 50 states. These customers are large retail chains and smaller independent operators. Products produced or distributed by the snack food product segment are supplied to customers through either direct store delivery or direct delivery to customer warehouses. Products delivered using the company-owned fleet direct to the store is considered a direct store delivery. In this case, we provide the service of setting up and maintaining the display and stocking our products. I actually worked for Coca-Cola in college, and I was a merchandiser. I would go to about 10 supermarkets and then set up the displays. And if the supermarket had a really big sale, like a big discount on Coke products, I might have to stay there for several hours and go to the back, bring more Coke to the front. It was actually a pretty fun job. Products delivered to customer warehouses, this is probably stores like BJ's or Costco, are distributed to the retail store and stocked by the customer, and then resold to the end consumer. Let's look at their balance sheet. 89 million of current assets, 21 million of current liabilities. So their current ratio is 4. They can cover their current liabilities with their current assets 4 times. 16 million of cash, 29 million of accounts receivables. This is how much money stores owe them. More than half their accounts receivables are to Walmart and Dollar General. So that means they supply products to Walmart and Walmart doesn't pay them. They will pay them in a month or 2. It's a good way for Walmart to manage cash flow. The longer Walmart could wait to pay a customer, the better. The better for Walmart. They always have lots of inventory on hand, 40 million of inventory. Here's a breakdown of the 40 million. 12 million of meat, ingredients, and supplies. 4 million of work in progress. 25 million of finished goods. Usually you don't want to keep too much inventory on hand. In this case, it could go bad, it could expire, but it also ties up cash flow. The more inventory you have, the more you're out of cash, because you have to buy the inventory and then manufacture it, then sell it, and it could take a few months to get payment for that inventory. That's the hardest part of a lot of businesses, managing cash flow. I know many companies who went bankrupt because they bought too much inventory. Prepaid expenses of 2.3 million. This is when a company makes an advance payment for a product or service they're going to receive in the future. Sometimes a company prepays rent for a year, so they have to keep it on their balance sheet as an asset, and each month they use the property, they remove that asset and book it as an expense onto the income statement. They have lots of PP&E because they're a manufacturing company, 70 million. Other non-current assets, 12 million. Total assets, 171 million. That's why their equity is higher than their market cap, because they have so many assets on their balance sheet. It's not a bad thing, but you can't really sell these assets. You can't sell your warehouse or your equipment because you need it to run your business. You could sell your inventory. That's the idea of inventory, to eventually sell it. And cash is cash. You can use it at any time. Let's look at their liabilities. 11 million of accounts payable. This is how much money they owe companies for borrowing on credit. You see they have 30 million of accounts receivables, 10 million of accounts payable. You want that to be opposite. You want to have more accounts payable because accounts payable frees up cash. But they're a small company, so they don't call the shots. They kind of have to do what the bigger companies tell them. Accrued payroll, 6.4 million. These may be bonuses they owe their employees. Total current assets, 21 million. Let's look at this note. They owe 3.4 million on this note that's due beyond 12 months. They owe 1 million on the same note that's due within 12 months. So it's about 4.4 million they owe. Here's more detail on the note. They owe 4.4 million. 1 million is due within 12 months. 3.4 million is due beyond 12 months. And they're paying 3.7% interest on that note. So it's a pretty decent rate. Companies have to use debt to fund receivables because they're waiting for Dollar General to pay them. So they may have to borrow money from a bank to buy more inventory or for payroll or for any expense. They have 9 million of deferred income taxes. These are taxes a company will eventually pay but are not due yet. And this 9 million is due beyond 12 months since it's not in the current section. They owe 3.1 million on their leases. That's due after 12 months. Within 12 months, they owe 1.3 million. So total liabilities, 43 million. They raised 17 million from selling their business. You sum up the 9 and the 8. They profited 120 million from running their business. Retained earnings is a sum of all the company's prior net incomes. Let's take a look at their statement of cash flows. They only show this for the trailing 6 months, not the trailing 3 months. And the purpose of operating cash flow is to convert net income into cash, because net income is your accounting profit or loss. It's not actual cash. They generated a similar amount of net income in 2022 and 2023, around 1.1 million. But in 2022, they generated 2.3 million of cash flow. In 2023, 1.3 million. Let's try to figure out why. They had a similar amount of depreciation and amortization. It looks like they did more promotions last year, 2.3 million. This year, 1 million. Promotional allowances are funds set aside for promotions because promotions detract from your revenue. Promotions are like discounts on products. The big difference is changes in accounts receivables. Last year, they extended 2.4 million of credit. So that was a cash outflow. This year, they received $3.8 million from that accounts receivable. It is a lot easier to understand these numbers for a smaller company. When it's a huge giant of a company, there's so many things going on, so many moving parts, it can get pretty confusing. This is a little more straightforward. In their investing section, they added $1.3 million of PP&E. So they may have bought a warehouse for $500,000. They may have bought some equipment for a few $100,000. Here's the only breakdown of the $1.3 million of PP&E. $378,000 of frozen food products, $915,000 of snack food products. Sometimes they have to sell equipment if they don't need it anymore. Maybe they bought new equipment. So they received $161,000 from the sale of equipment. In their financing section, they had a cash outflow of $255,000. That was on their lease payments. They paid back $500,000 from bank borrowings. They don't have long-term debt, but they do have lease payments, which is a kind of debt. Here's a list of how much they're going to owe on their lease payments. $1.4 million this year, $700,000 next year, then $900,000, $1 million, then after 2026, $600,000. So $4.6 million of lease payments. It could be expensive to buy a warehouse. It could be several $1,000,000. It's a lot cheaper just to lease it from somebody. Let's take a look at this company on Simply Wall Street. Its last price was $11.23, $102 million market cap, down 16% in the past year. Let's learn a little about the company. Founded in 1932, 700 employees. Bridgford manufactures, markets, and distributes frozen, refrigerated, and snack food products in the U.S. It operates two segments, frozen food products and snack food products. The company mainly offers biscuits, bread dough items, roll dough items, and dry sausage and beef jerky products. It provides 130 frozen food products to food service and retail customers through wholesalers, cooperatives, and distributors, and 160 food items to supermarkets and mass merchandise and convenience retail stores through customer-owned distribution centers, as well as a direct store delivery network. They were founded in 1932. They've been around 91 years, and they're headquartered in Dallas, Texas. Their trailing 12-month revenue is $259 million. Of that $259 million, $191 million is cost of revenue. The leftover amount, the $68 million, is gross profit. Of that $67.6 million, $22.6 million are other expenses. An example of other expenses is marketing. And what's left over is earnings, $45 million of earnings. Their EPS is $4.96. Gross margin 26%, net margin 17%. Really low debt to equity ratio, 3.5%. That means for every dollar of equity, they have 3.5 cents of debt. The one risk they list is high level of non-cash earnings. Here's some of their competitors: Lifeway Foods, $93 million market cap, Mama Mancini's, Seneca Foods, and South Dakota. It looks like the stock started trading in 1990. After only 2 years, it got close to $20. Then it took about 27 years to get back up to that point because it came down. And then by the beginning of 2019, it finally broke through that peak in 1992. Its highest point ever was $36 in September 2019. But it's down around 70% since that peak. In the past week, the stock is down 2.4%. The industry is down 0.07%, and the market is down 1%. In the past 30 days, the stock is down 1%, the past 90 down 11%, the past year down 16%, past 3 years down 33%, and they're doing better in the past 5 years compared to the past 3 years, down 18% in the past 5 years. Much worse than its industry in the market, though. Their PE in 2018 was 17, then it was 643 in 2021. It looks like they had negative earnings in 2022, so we can't look at the PE. Now their PE is 2.3, so it looks extremely attractive. Price to sales of 0.7 in 2018, it got up to 1.7, now it's 0.4. Price to book of 2.1 in 2018, it was up to 4.5 in 2019, and now it's below 1, it's at 0.8. Simply Wall Street didn't value this stock, and there's no analyst price targets. In 2012, their trailing 12-month revenue was $127 million. It grew very little over the next 4 years. Then it jumped up in 2018 to $170 million. It had a decent growth into 2019 and 2020. It was 191 million in July 2020. Then it grew a lot over the next 2 years, up to 265 million. It has regressed a little bit the past couple of quarters, but their earnings don't look so bad. For the most part, they have positive earnings. There were a few points when it was negative, but most quarters are positive. In the past few quarters, it's been really high, 39 million, 45 million, 45 million. And their operating cash flow has usually been positive. Lately, it's been negative. I think they're spending a lot on inventory, and maybe they're spending a lot trying to expand. So it could be a good time to get in on the stock. I like this a lot better than PetMed Express. They only have 4.4 million of debt, which is 3.5% of their equity. Their equity is 127 million. And they have almost 16 million of cash on their balance sheet, so they could pay off all that debt if they wanted to. And they could easily cover their interest payments. They can cover their interest payments with their operating income 7.5 times. We know they have lots of assets on their balance sheet. We looked at their balance sheet earlier. They have a lot of PP&E, property, plant, and equipment. They used to be debt-free from 2013 to 2018. They had no debt. They did start to add debt. It peaked at 42 million in April 2022. But it looks like they paid down most of their debt. It's down to 4.4 million. This might be the right time to enter into this stock. It could explode soon. This is a family-run business. Baron Bridgford is the president. The chairman of the board, Michael Bridgford. Alan Bridgford, the director. William Bridgford, VP and director. A lot of people on the board have a tenure above 10 years. D. Scott, 17.5 years. Todd Andrews, 19 years. 10.5 years, 12.5, almost 19 years. 79% of the company is held by private companies, 14% by the general public, 5% by institutions, and 2% by insiders. It looks like the family owns 79% of the company, Bridgford Industries. The investment company Dimensional Fund owns 2% of this company. Another Bridgford owns 1.7%. Newberg Investment Advisor, 1%. Richard Bridgford, 0.4%. William Bridgford, Baron Bridgford. They employed 519 people in 2012. Now they have 700 people. That's a decent sized staff. And they've been trading on the NASDAQ for 51 years. So that's the end of the video. Let me know what you think. Give it a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.